Hello everyone, I'm Dr. Phanor, and today I'm going to give you a brief lesson about progressive, proportional, and regressive income tax structure of federal income taxation. So to give you a brief introduction here, the first income tax was enacted about 150 years ago. It was not until a constitutional amendment was enacted in 1913 that the individual income tax became a reality. Much of the Internal Revenue Code as we see it today was enacted because of the 16th Amendment. So now we have something called electronic filing, which over 85% of tax returns are usually filed in an online type of atmosphere. There are several reasons why it wouldn't be filed in an online type of atmosphere, possibly amendments, possibly because the person is also filing as a non-resident of the United States or a non-citizen, maybe applying for an individual tax identification number with a W-7. So there's many reasons why somebody wouldn't file electronically. So tax collections from individuals make up the largest part of tax collections, and it's not businesses. Okay. So as we see here, over 148 million individual tax returns were filed in 2014, and they just keep on rising. So we have three different types of structures usually when we talk about taxation. The first one, as it indicates here, is progressive tax structure. As indicated here, it's the tax rate increases as a tax base increases. For instance, the more money that you make, the more that you're going to be taxed. And that's essentially what it is. So when we think about these lower class citizens, it doesn't make sense for the lower class citizen or the middle class citizen to be taxed the same way that an upper class citizen is being taxed, right? So in that event, we try to normalize it and equalize it in a way that is fair for everyone, right? So there's a lot of notions about it not being fair. However, the tax structure that we currently have ranges from 10% to 39.6% as far as up to 2016. We also have here a regressive tax structure. Again, regressive tax structure. As indicated here, the tax rate decreases as the tax base increases. An example of this is a Social Security system. So the more money that you make, it gets up to a certain threshold when they stop retrieving as much money from the tax system as they are based on your tax return. So, for instance, Medicare taxes on your W-2 should be shown as 1.5% of your earnings. As far as Social Security tax, it's 6.2% out of your earnings, up to a certain amount. So with that being said, it becomes a regressive tax structure because of that, meaning that the tax rate is going to decrease as your tax base increases. We also have a proportional tax structure. As it indicates here, the tax rate remains the same regardless of the tax base. So for instance, maybe you're buying some clothes from the mall and it's at 6 or 7%, or maybe you live in a state where it just has a flat tax rate, or maybe you live in a state such as Florida or Texas or Arizona without any tax, right? So with that, doesn't matter how much you make, it's just going to stay the flat rate. And when we think about just marginal and average tax rates, think about the average, and we often go through these calculations many of times within our lives. The average tax rate, as it indicates here, is a total tax paid on a certain amount of taxable income. So when we think about an average, we're going to do the total tax, right, divided by the taxable income. Okay. And we have something called marginal tax rates that indicates here, determined with reference to tax rate schedule. For example, a married couple will pay a marginal tax rate of 15% on their $5,000 of income, meaning that as you continually progress in income or degress in income, the tax rate kind of changes. Okay. It's important to clearly understand that the difference between an average and a marginal tax rate. Again, an average represents the arithmetic average. It's the total tax divided by the total taxable income. And some income may be taxed at a higher or lower rate, right? So some of that income. So your income from $0 to $10,000 may be taxed differently than your income from $10,001 to $19,999. Okay. Now here's a short calculation about the income tax formula. As says here, income minus permitted deductions of income. And these permitted deductions of income may come in different ways. They may come from deductions from educator expenses, deductions from business expenses. So there's a lot of ways that these deductions may come about in order to signify exactly what your taxable income is. And from that taxable income, then we multiply that by the appropriate tax rate based on the income that you have. And based on that, you have your income tax liability, how much you currently owe back to the government. But because we usually pay during the year into the system of the income tax system, we sometimes come with a refund. So say, for instance, your income tax liability is $10,000 and you give the government $15,000 during the year, then you can expect a $5,000 refund. And it's really that simple. So that's really about the income tax formula.